Hey everyone, and welcome back to the Rich Habits Podcast, a top 10 business podcast on Spotify. My name is Austin Hankwitz, and I'm joined by my co-host, Robert Croak. Robert is a seasoned entrepreneur in his 50s with lifetime revenues of over $300 million, and I'm an entrepreneur in my late 20s with a background in finance and economics. Since quitting my full-time job in corporate finance a few years ago, I've built a seven-figure media business and actively advise some of the most well-known fintech companies around the world. As the show name might suggest, every episode, we talk about rich habits as they relate to business, finance, and mindset. However, we try and bring you two unique perspectives. One from an industry veteran, which is Robert, and the other myself, someone who's still in the process of building wealth and figuring it all out. So Robert, what are we going to be talking about in today's episode?
Given the recent market volatility we've seen in September, we've had dozens of podcast listeners ask us about diversification. Not just buy gold, but truly uncorrelated returns to the stock market. So we're doing just that. We've invited Scott Lynn, the founder and CEO of Masterworks, on to explain to all of our listeners how artwork investing actually goes down. The true behind the scenes look into how everyday investors like Austin and myself are able to gain exposure into artwork that has historically seen strong uncorrelated returns when compared to the stock market.
As you all know, I began investing with Masterworks in 2018 after I saw an advertisement for their offerings on Morning Brew. I set up a call with one of their investment professionals to learn more about my options as a retail investor looking for some diversification, and they made the art buying process incredibly simple. So we want today's episode of the show to act sort of as an opportunity to pull back the curtain on what's actually going on at Masterworks, just like we've done with Jay Jacobs from BlackRock and their Bitcoin ETF in the past. We're going to discuss how they source new pieces, how they securitize them, right? Allow everyday people to invest in them, where the artwork gets physically stored, what the insurance process is like, and many more in-depth topics about art investing.
So Scott, thanks for joining us on this week's episode of the Rich Habits Podcast. So give yourself a quick introduction, talk about Masterworks a little bit, and then we'll dig into the questions.
Yeah, thanks for having me. So as you guys mentioned, my name's Scott Lynn. I'm the founder of Masterworks. Unlike your guys' introductions, I'm not going to say my age, but I appreciate you having me on. So let's dive in.
Okay, Scott. So now speaking to tens of thousands of retail investors, entrepreneurs, and forever learners, a lot of them have heard about index funds, ETF, and other long-standing investment vehicles and have done a great job building those well-diversified portfolios around those things. So explain to us, Austin and I, all of our listeners, what is investment grade artwork, number one, and why would someone want to add that to their already well-diversified portfolios?
It's a great question. So to answer the question, maybe it's helpful to just take a step back and understand the macro dynamics of the art market, right? When you think about the art market today, it's a roughly $1.7 trillion asset class. That's a number that Deloitte publishes. I like to compare and contrast that to venture and private equity, which is roughly a $3 trillion asset class. So it's roughly half the size of venture and private equity. Each year, about $60 billion in art changes hands. Now, the interesting thing about those stats, and it gets to your question around what is investable art, is out of that $60 billion that changes hands, approximately 64% is from the top 100 artists. And most of these top 100 artists are no longer living. So these are artists like Pablo Picasso, Basquiat, Banksy, Andy Warhol, household names that many of your listeners have probably heard of. Those artists have enough data to really conclude that over time, their prices are appreciating at predictable rates, right? They have a low degree of volatility. So these are definitely not artists where, you walk down the street in your hometown and you go into a gallery and you buy a painting for $10,000. We liken, that sort of artwork sort of is to like buying a lottery ticket. You should buy it because you love it. You shouldn't buy it for investment purposes. So when we talk about investment grade artwork, it's really these artists that have existed for decades or in some cases centuries. And there's very long track records around their prices that they've achieved over time.
Got it. And so then I guess back to that second question, why would someone want to add that to their already well-diversified portfolio?
I always think of this conversation I had with one of the heads of research at a major private bank, and he said there's two very simple criteria for including an investment in your portfolio. One is that the investment must outperform inflation, and two is it must lack correlation to everything else you're investing in. By lack correlation, I just simply mean if the stock market goes up, that new investment doesn't also go up and vice versa. So the interesting thing about art is when you look at contemporary art, which is really art created after World War II, that segment of the art market almost has zero correlation to every other asset class. I think the highest correlation is actually gold, which is roughly 0.2, which isn't that uncorrelated. So independent of the appreciation rate of art, it acts as a really good diversifier as part of a portfolio.
I love that. And it's probably one of the things Austin and I speak about the most is diversification, because, you know, you and I, Scott, are both old enough to have been through a few ups and downs in the market. And, you know, a lot of people out there just have never seen the 2009, 2010s and some of the 1990s of what happened when people get wrecked in the markets. And so that's why I'm a big fan of diversification and always been a huge fan of art, just because I think the lack of correlation to the stock market and the crypto markets and all the other markets makes it such a great investment strategy to get that diversification you want. So let's talk now a little bit about the sourcing process. According to your website, your team at Masterworks have purchased over 450 pieces of investment grade artwork. So what goes into identifying those 450 pieces, and why do you choose those specific pieces over others? Because you made a great point, is you see all of these galleries with unknown artists with $10,000 and $20,000 price points. And I always say the same thing too. That's like buying a lottery ticket, because you don't know if any of those artists are ever going to reach that level of the Basquiats or the Banksys to where the real value is there and is going to be determined over time. And I really like that part of what you said. So dig into the sourcing process, and where do the metrics come from for this?
Yeah, so maybe let's just start with like, how is there data on the art market? So the interesting thing about the art market is that art has been traded publicly at auction for literally centuries. Sotheby's was a publicly traded company up until I think 4 or 5 years ago on the New York Stock Exchange. It was actually the oldest publicly traded company on the stock exchange. I think it's now 270 something years old. So art literally has been traded between collectors before modern day financial markets existed. So when we talk about analyzing data, we really talk about analyzing that auction data over many decades within the art market. So our research team goes out and we look at, literally millions of data points on paintings that have been bought and sold over time to try to understand which artist markets are appreciating at the best risk-adjusted returns. That's really critical, right? Because you can see artist markets that skyrocket right away, but they don't necessarily have predictable returns in the future. So we're always trying to focus on which artist markets produce the best risk-adjusted returns. Once we have that list of artist markets, we basically hand off the list to our acquisitions team, which in today's world is the biggest buyer of the art market, and they go out and they source paintings within those given artist markets. So to give you an example, in the Basquiat market, which is one of the artist markets that we buy, there's roughly 1,100 paintings that Basquiat painted during his lifetime. There's 600 or 700 paintings that are kind of available in private collections, and we've been offered over the course of the last 5 years about 300 of those paintings. Out of those 300 paintings that we've been offered, we've purchased, I'll get the exact number wrong, but somewhere around 15. So we're incredibly selective, not only in the artist markets that we select, but also in the paintings that we buy after we look at those artist markets.
That makes a ton of sense. So what you're saying is that just like the stock market, there are thousands and thousands and thousands of things to invest into, right? With the stock market, it's companies. With the art market, it is actual pieces, right? There's so many different pieces out there. But you're saying instead of investing kind of like the stock market, instead of investing into some random penny stock or some random company, let's figure out sort of these secular growth trends that are happening that some of these more successful companies are operating inside of. And we've seen some really cool data points to prove that. Let's go identify what those data points are now in the art market. And those trends could be specific people. Maybe there are other specific data points that you said that you had mentioned that you guys are following closely. And then from those, you guys are really digging deep and figuring out, okay, of the 300 that we can, sensibly invest into, these 15, those seem the best to us. So I'm curious, that is a 5% conversion. Is there any specifics that you can share with us as to what, that 5% really turns into?
It's very small. It's far less than 1%, because if you think about the artist markets that we're buying today, we're active in about 70 artist markets. There's more than 1,000. So that alone is less than 1%. And then when we source works in each of those markets, we buy, depending on the market, anywhere between 2 and 5% of what we see. So we're really buying a very, very, very small portion of the art market overall.
Makes a lot of sense. Well, now let's talk about your track record, right? Your website says that you've distributed $60 million plus back to your investors as cash profit proceeds. So walk our listeners through the entire timeline now of investing into artwork, from sourcing it to holding it and then distributing those proceeds. Maybe talk about the insurance process. I'm an investor on the platform. I see my unrealized returns of 34% on a specific investment. So like use me as an example, maybe.
So the process is relatively straightforward for people that understand how companies go public. We go out, we go through the process that we just talked about. We find a painting that we want to buy. We purchase the painting with our own capital, and then we file it as a public offering with the SEC. So the exact same process, more or less, that a company goes public, we go through. You know, if your listeners are finance geeks and they want to see what one of these looks like, you can go to sec.gov, search for Masterworks, and you'll see literally thousands of public filings on all of these different paintings. So once we file it as a public offering, we then start selling shares in the painting. The offering closes. We distribute shares to all of the investors, which you can see the number of shares that you own in your account. We appraise those shares on a quarterly basis. And then we tell people to think of these as 3 to 10 year illiquid investments, right? So when you're thinking about what percentage of your portfolio should you allocate to art, you should always be thinking about that as a very long-term investment. This really shouldn't be capital that you need access to tomorrow because they are long-term investments. And then we have a separate team, a private sales team that operates out of a gallery in Uptown New York that is responsible for selling that painting at the right time back into the art market. And we then distribute proceeds to people then. Independent of that, we have secondary markets where people can trade shares on those secondary markets. But I always, at least personally, tell investors to assume that these are long-term investments and you shouldn't have to use the secondary market. You can opportunistically, but it's really a fallback position to a longer-term hold.
I think it makes a ton of sense. And so kind of going back though to like the sourcing and the holding process, where do you guys store the pieces? Well, I mean, don't give me specific coordinates. I don't want anyone to like go like get too excited and try and break in somewhere. But how do you guys store them? And then like, what's the insurance process like? I mean, I'm sure these are all insured pieces as well.
Yeah, so we have, I think, one of the largest insurance policies, if not the largest, with Lloyd's of London. A policy that's well over $1 billion. So every vehicle is fully insured. The paintings are stored in the state of Delaware, actually, because we avoid sales and use tax when we acquire and subsequently sell paintings. And that, that doesn't sound like a huge deal, but when you actually factor that into the total returns, it's quite significant for investors that, depending on what that actual tax rate is. So that's just a strategy to maximize returns ultimately. But yeah, they're all kept in Delaware.
I love it. Yeah, I talk about it's not what you make, it's what you keep all the time. So I'm sure our listeners love the fact that you guys are looking out for every single dollar because, a lot of times you can have all this money changing hands, but if the profits aren't there for investors, it's going to hurt you long time. So let's get into that part of this. Your website claims investment grade artwork outperforms the S&P 500, and you have a chart that we'll show on the screen that shows from January of 2000 how the S&P 500 has only returned 250%, while investment grade artwork has returned over 700%. So let's walk the listeners through why is that? Artwork doesn't have a dividend, it doesn't have profits, it doesn't have customers, it doesn't sell anything. Why does artwork go up so much in value?
It's a great question. And I think it's probably very similar to any other asset class. Like the chart that you're referring to is called the Art Price 100. You can access that index at artprice.com. I think when we think about supply and demand in the art market, there's something that's very unique about art as an asset class that's different than almost every other asset class. When you think about the demand side, I think it's relatively straightforward. Demand is driven by ultra high net worth people living around the globe, that are interested in buying these paintings. And the more high net worth people there are, arguably the more demand there is within the asset class. The thing that's very different, however, is actually the supply side of the art market. And most people don't totally appreciate the value of this dynamic. So when collectors buy paintings, when an artist is living and the artist paints paintings, then they sell paintings in a gallery, collectors start collecting the paintings, those paintings are circulating privately within the market. Most collectors over time, particularly after 1 or 2 generations pass, wind up donating those paintings to museums. That's how museums acquire most of their collection. So, an example of this is an artist named Jackson Pollock, who I know well. In today's world, there's less than 20 Jackson Pollock drip paintings in private collections. He's the artist that, dripped all over the canvas. His best paintings are worth over $200 million. He painted hundreds of paintings during his lifetime, but now there's only roughly 20 left that you can buy. And honestly, the 20 that are left that you can buy, there's a couple of A examples, but they're mostly B and C examples. And the B or C examples sell for $30 million because that's all that's left. So that dynamic of continuously decreasing supply, when artists become more and more well-known and effectively canonized in a lot of art history books and culture generally, is what probably causes prices to rise.
And I want to jump in with one quick question, Austin, and I know you've got a good point to talk about, but one quick question that you alluded to is walk me through, and the listeners, because I'm really intrigued. it doesn't seem like there's a lot of these new Banksys and Jackson Pollocks and all of these names that are building up in the art market, which then I believe would add to more and more scarcity in the market itself. So how often do you see a new artist that really just rises to the top, becomes famous, and then their pieces then follow along in price, appreciation?
That's a great question. I guess it depends what the definition or what the threshold of, quote unquote famous is, but it's very rare. I mean, in terms of artists that we add to our list that are what we would consider mid-career living artists, we might add a couple a year, a couple every other year. It's definitely infrequent.
So what it sounds like then is kind of back to your answer to the previous question, was that demand stays steady, if not rises over time, as people want exposure to these artwork pieces, while the supply continually goes down because more and more people are just gobbling them up and they just don't sell them. And so Masterworks now is a part of that demand, and you guys are purchasing artwork on behalf of people like me who don't have $200 million to go buy a drip painting, but so allowing us normal retail investors the opportunity to have some exposure to that in our portfolios, so that as the demand increases and supply decreases, therefore economics 101 tells us prices go up, we can then realize that in our own portfolios.
That's exactly the thesis.
So in general, we encourage, from an investing perspective, our listeners to sort of build their base of $100,000 invested into long-standing index funds that we all know and love, like the S&P 500 or the NASDAQ, things like that, before investing into alternative asset classes, including artwork, also cryptocurrency, things like that. Then once they're ready to start investing, maybe allocate 15 to 20% of their net worth to these alternative asset classes, including crypto and gold and collectibles, things like that. So personally, I'm like a 2% of my net worth invested into artwork, but I'm curious, what sort of trends are you seeing as it relates to artwork allocation in a net worth or a portfolio? Are you seeing people allocate that single digits? Are we in the double digits? Are we above 15, 20%? What are the trends that you're seeing, Scott?
Yeah, I mean, I think the trends that we're seeing tend to be lower single digit percentages, not dissimilar to yourself, but we see people growing those pretty rapidly over the course of a number of years, right? So if someone starts out at 2%, a year later, that might be 4%, a year later, they might be 6%. But we did, for those listeners that are familiar with Mercer, we did work with a firm called Mercer, who's a large consultant that advises a lot of asset managers. I think they advise more than a $10 trillion, $40 trillion, some huge number in assets. And we spent over a year working with them to try to think through what is the right asset allocation model for art. And very broadly, I would say, if you're a conservative investor, it's somewhere between 5 and 10%. Again, over a long period of time where you get comfortable with the asset class and you're confident that you can hold an investment for 3 to 10 years, and then 5 or 10% more, depending on how aggressive you get on that scale. And a lot of that is just driven by the fact that when you look at contemporary art historically, it's outperformed public equities and it has low correlation. So it acts as this very interesting diversifier while still producing good returns. But again, the caveat is being able to hold that long term over a 3 to 10 year horizon.
Last question, Scott, is do you see a world, or is it already in the works, where we're going to see liquidity platforms based on blockchain and NFTs to where people would have liquidity auction opportunities in this type of investing if they needed to get out of it and didn't have a way to put liquidity into their investment if they got in a pickle and needed to get some money out? Do you see a world where blockchain and NFTs are going to, kind of resolve that liquidity issue?
I guess there's a couple of questions there. So we do operate a secondary market, so people can trade shares on our secondary market and sell shares in their secondary market. The other thing that we're working on, which is, there's no certainty around this and it's a year-plus project, but is allowing investors the ability to open margin accounts using their securities as collateral to also more quickly access capital if they need to. I think in general, one of the challenges of the asset class, which you probably hear me repeating this, is just it's a long-term investment. And I think the more we can do to make that easier for people to tolerate, the more adoption there will be to the asset class overall. To your other question around NFTs, I've always been, and I depending on the point in time, I've been proven wrong, but I've always been the anti-NFT person. And it's not that we have anything against NFTs as the Masterworks Masterworks high level. I think the thing that we struggle with is when we look at data around NFTs, we can't really conclude that they're predictably appreciating. So if you go back to my definition of what should be included in a portfolio, it's something that beats inflation and lacks correlation. And I just don't know if you can conclude that in NFTs. They're sort of, the prices are kind of all over the place. They seem highly volatile. I can't tell if they're correlated or not correlated. The data is fuzzy because of, how all these different trades on the blockchain. We've just never gotten comfortable having a typical investor who's investing in an IRA account allocate to NFTs, but maybe that changes in the coming years.
Got it. Scott, thank you so much for joining us on this week's episode of the Rich Habits Podcast. If you're someone looking to learn more about adding artwork to your investment portfolio, be sure to check out masterworks.art/Rich Habits. Scott, thank you so much for joining. You just opened my eyes up even more. I've loved art for decades, and I just love learning from people like you, because with Austin and I always talking about diversification, we're talking about artwork and cryptocurrency and wine and whiskey and all of these things. It's just great to dig in, get behind the curtains, and really understand these markets, not only for ourselves, but for all of our listeners.
Awesome. Thanks for having me.
Thanks, Scott. Dang, dude, what an awesome interview with Scott Flynn. I mean, I understood how artwork investing happened, right? Generally speaking, just like I understand how Bitcoin ETFs work with Jay Jacobs, but really getting to sit down with the person who's pulling the strings behind the scenes and doing the things that they say they're doing is just so much more enlightening, if that makes sense.
Yeah, I love it because we get the opportunity all the time to interview these crazy smart people that are behind the scenes, like you said, and we get to pull back the curtain and help all of our listeners understand more about what they're getting themselves into. What are these investment sectors? What are the best companies? How does it work? What are the returns like? Because, there's a lot of different ways through diversity to really win in the game of investing, especially during tumultuous times. So today's episode was fantastic.
Well, that reminds me, Robert, that we are going to be hosting the president of Shopify on our podcast here in the next couple of weeks as well. A lot of people say, hey, try and do this e-commerce side hustle. I'm trying to sell on TikTok. I'm trying to sell little things. And so we're like, all right, people trying to do these side hustles. Let's reach out to Shopify, the side hustle online e-commerce king, and see if they want to talk to us. And they do. So stay tuned for that. And if you have any other ideas of people you want us to bring on the show to help explain things to you, if they're an expert, if they own a company, whatever, just let us know, because that's the whole point of this podcast, to bring to you guys the opportunities to learn from the experts themselves, as well as share our own rich habits on a twice weekly basis. Now, before we move on, we want to give a quick shout out to one of today's episode sponsors, Moby. The Moby app provides busy professionals with a filtered view on the most important financial news of the day and latest research on profitable trends in the stock market, all with notifications straight to your phone that only takes 3 to 5 minutes to read.
That's right, Austin. Moby's insights are driven by the team's experience at Morgan Stanley, Bank of America, and Goldman Sachs, making what used to be complex financial information into easy, profitable, and concise stock market recommendations for you.
I personally love reading the daily email updates, and their Moby stock picks have been ridiculous over the last few years. For example, their 2023 stock picks had an average return of 30%, 2022 stock picks an average return of 35%, and 2021's picks had an average return of 28%.
Well, the ultimate goal of the Rich Habits community is to help you take back control of your money, and Moby is one of those tools that we believe will help you do just that. So check out the link for Moby Premium in the show notes below or in our stand stores, and as always, let us know if you have any questions.
This episode of the Rich Habits Podcast is brought to you by NEOS Investments. They just launched a new addition to their high-income ETF lineup that provides exposure to the 2,000 small-cap stocks that make up the Russell 2000 Index, while aiming to provide tax-efficient monthly income to their investors. Their ETFs may be especially interesting for folks looking to generate passive income inside of their investment portfolios.
As you've probably heard us mention recently, small-cap stocks have historically performed well when rate cuts begin after a long period of high interest rates. So if you're looking to add passive income ETFs to your portfolio, especially as the Federal Reserve may begin cutting interest rates in the coming months, consider learning more about NEOS ETFs at neosfunds.com. As with all investments, investors should carefully consider their investment objectives, risk, charges, and expenses of NEOS exchange-traded funds before investing.
To obtain a prospectus containing this and other important information, please visit neosfunds.com. Please read the prospectus carefully before you invest. An investment in NEOS ETFs involves risks, including possible loss of principal. The equity securities purchased by the funds may involve large price swings and potential for loss. Past performance is no guarantee of future results. All right, Robert, let's now jump into this episode's Q&A portion. This is my favorite part of every episode, and this question, funny enough, was left as a Spotify comment. It wasn't really a question. It was just him, as we'll see here, David G, roasting us in the Spotify comments. So we thought we'd address it because we love being held accountable. And if you guys have a perspective that's different than ours, like, let us know. So let's just kick this off. David says, once again in today's episode, you all talked about the virtues of a bridge account and say that people who are IRA rich and under 59.5 are stuck with a 10% penalty if they want to get some cash out. This is not true. First, let me say that I like bridge accounts and I followed that ideology myself, but people who have money in a retirement account and want to take it out before 59.5 have a way out. It's called the SEPP, which stands for the Substantially Equal Periodic Payment Plan. He says the comment section is too small to detail it, but look it up. You guys need to talk about it. Okay, so Robert, let's kind of take a step back. Explain to our listeners just a quick 15 seconds why we like bridge accounts.
We like bridge accounts because we want to make sure throughout your investment journey towards retirement, you have a portion of your portfolio's overall money that is available to you and has autonomy to you to control it. Because remember, we talk about this all the time of people that are net worth millionaires, where they have all this money in a 401k and all this equity in a home, but they don't have access to any of it without penalties or selling. And so that is why we love the bridge account. And I love this call out because I think we can kind of roast him back here because I don't feel this is a good strategy at all using an SEPP. So I can't wait for you to break it down as to why we think it's a terrible idea unless it's an absolute emergency.
So let's break that down. The substantially equal periodic payment is a method of distributing funds from an IRA or qualified retirement plan prior to the age of 59.5 that avoids incurring the IRS penalties for those withdrawals. Typically, people who remove assets from a retirement plan before 59.5 pay an early withdrawal penalty of 10% of the amount that they took out. Now, the funds in the SEPP plans are withdrawn penalty-free through a specified annual distribution for a period of at least 5 years or until the person does turn 59.5, whichever comes later, which means, and we'll talk about how the money kind of moves around here, but let's say you're 35 or 45 years old, 45, and you want to start tapping into your retirement and use one of these SEPP plans. You can do that without paying that 10% penalty. You'll still pay taxes on it like you would if you were taking it out in retirement anyway, assuming it was a normal IRA or a normal 401k. But the amount that you get paid, the amount you take out is the same every single year, and you have to do this until 59.5. Like if you start at 45, you have to withdraw the same amount every single year for the next 15 years. You can't stop it. And if you stop it early, you got to go back and pay all the penalties, all the fees, all the interest, everything of the money you took out early. And if you, let's say, do this now at 58 years old, so a year before 59.5, what sucks is you are now locked into these same annual sort of withdrawals for at least 5 years. So it'd be 63, which is an age that you can take out any amount of money that you want from your retirement account, but you're kind of locked in now for that 5-year period.
So yeah, I just don't like these plans because let's say you have $250,000 in this account and you need money and you initiate this SEPP plan. You don't have any real control of how much you get for that first lump sum because that is determined by the plan. But then also don't forget the fine print. You will be required to withdraw for 5 years in a row the same amount. You might only need this money one time, but once you enter into this plan, you are stuck and bound by this plan to take it out for 5 years in a row. To me, that seems like a disaster because you're borrowing, against your future. And I just don't like it at all unless it's an absolute desperation move. But otherwise, I wouldn't touch it, especially if you're younger in your 30s or 40s.
So David G, are you right? Yes, you are right. There is such thing as a substantially equal periodic payment plan, the SEPP, which allows people to enjoy money before retirement and not pay penalties on it. Still pay the same income tax they would, but no penalties. That is correct. It does exist. The drawbacks, though, are that it is relatively inflexible. Once you begin the plan, you must stay in it for its duration, which could potentially potentially be decades if you start in your 30s or 40s. And during that time, you have little to no leeway, allowing you to alter the amount of money to withdraw every single year. And you can't quit the plan. Quitting the plan is not really even an option, because once you do that, it imposes on you all the penalties you save from launching it, plus interest. And we all know the IRS loves their interest. So does it exist? Yes. Is it smart? No. I don't think this is a good idea for anyone to go about. But, theoretically speaking, yes, you're right. This is a way to get money out before 59 and a half. But you know what's a lot easier, David G., is the bridge account. And I'm glad to hear that you use the bridge account. We use bridge accounts. We want to encourage people to have a bridge account, because you can absolutely take out as much or as little, and you can invest these accounts into anything you want. I mean, it is a public.com brokerage account, and they are so simple and easy. So thanks for the comment on Spotify. We appreciate our audience, holding us accountable, sharing their thoughts, even, if it's a dig. But that's what we're here for, to give you guys our perspectives on whatever's out there.
Yeah, but also we have to look at it, and David, we appreciate the insight, but we have to do what is best for our audience. Our job as educators is to flush out every opportunity, investment or otherwise, in what is the best foot moving forward for our listeners. And so in this instance, we appreciate the call out, but we just don't agree with it. Yes, technically you're correct, but it's just not something we would recommend to our audience.
So our next question comes from Jordan J. Jordan says, "Hey, Austin and Robert, I love the podcast, and I've rated you guys 5 stars on Spotify, and I've recommended you to a couple friends and family, and they said that you are awesome." Now, Jordan's question is this: I'm 19 years old, and I'm looking to buy my first property. I have $10,000 in a high-yield savings account, $35,000 invested into ETFs and stocks and crypto. That includes my employer's 401k. Now, my plan is to buy this property and then rent some rooms out to my friends in college, aka house hack, like you guys say. My question is, though, should I have them sign a lease or some sort of contract? I want to make sure that they pay me, obviously, but I don't want to be the bad guy and ruin our friendship. I want to make it as formal as possible without being that bad landlord or weird friend. Any perspective you guys can share is really helpful. Thank you so much. And as a quick PS, I've known these friends my whole life.
Jordan, great question, but I'm going to break it to you. You have to have the contract. Because if you were to think about being married, being in a business partnership, anything else where you're combining efforts, especially living quarters, you need a contract. You need to spell out what their rights are. You need to spell out what your rights are as the landlord. You need to spell out everything financially, because just like a prenuptial agreement, if they don't screw up, it's never going to be used. But if they do screw up, you want to be the one holding all the cards, because you have a contract in place that gives you the rights to do what you need to do to remove them from the property or end the lease agreement. Because you can handshake all you want with friends, but over time, you don't know what happens. They could get a bad girlfriend, they could get a drug problem, a drinking problem, they could lose their job and just be a deadbeat because they're living for free and feel they can take advantage of you. So trust me, from someone that had let too many people and too many friends off the hook, even with contracts in the past, don't do it. Get the contract in place. It's not going to be hard on your friendship. You're just going to say, hey, I have to have this in place. It benefits both of us, and you will do fine over time, but you have to have the contract.
I love that perspective. I think at the end of the day, if they really are your friends, they'd understand. I mean, Austin, thanks so much for letting me live here. Yeah, man, no problem. But I just want to make sure that we're all on the same page on expectations. I expect you to pitch in, your share of the mortgage or the rent, whatever you want to call it, right? And then also maybe the utilities. Maybe there's specific, things they have to do to maintain the house, whatever it could be, right? But just use it as an excuse of listen, let's just make sure our expectations are completely on the table now that we're all living together and you're paying me money. It can be a very simple contract, but certainly make sure that you do have a contract. I think that is very, very important.
Yeah, I could talk about this topic for hours, but think about it this way. Let's say one of your best friends moves into one of the rooms. You spell out the common areas. They know what they're supposed to pay, but you don't have a contract in place, and all of a sudden he moves in his girlfriend and she moves in her friend. Now all of a sudden you have 2 freeloaders in for the price of 1 or 3 for the price of 1, and you have no say of what you can do, and it goes from them staying there for a few days to a few weeks to all of a sudden you have additional tenants putting a strain on your property, putting a restraint on your resources. So you have to understand, get the contract. I don't care how good of friends they are. I don't care if they're family. You have to spell it out contractually and legally.
Our next question comes from Andrew M. Andrew says, "Hey there, my wife is 30 and I'm 32. And we recently started listening to your podcast and have been loving it. It's made us so much more excited about what we can do with our money. We make roughly $350,000 a year gross. We currently have the following investments inside of Edward Jones: $88,000 in a money market fund, $103,000 in a CD, $104,000 in a traditional IRA, 33 in a Roth, and we've seen very moderate growth over the last 3 years, but just wanted to get started somewhere. Now, we also have another $102,000 in a high yield savings account at our bank that pays about 3.5% and $23,000 in our checking account. Since listening to your podcast, we've been wondering if we should pull the money out from Edward Jones and instead invest it into the suggested index funds that you all share on Public instead. We've been looking to diversify and get into real estate as we want to purchase a new home with 20% down between $120,000 and $160,000 in our area and then rent out our current home after that. What do you guys think about our situation? Robert, I'll let you kick this one off.
Andrew, you are doing a fantastic job. You have conquered the hardest thing in life, how to make money. You've got that dialed. But now my question is, you're 32 years old and your wife is 30. Why are you being such a scaredy cat? Everything I see here is low performance, safety, safety, safety. You're not 62. You're not 72. You should be getting out there and making sure that you are diversifying and building your base further with some real asset classes that are going to make you money. Now, totally appreciate what you've done, but you're sitting in so much cash and you're underperforming the market so poorly because you're not diversified into a basket of index funds. It doesn't sound like you have any cryptocurrency. You don't have any alternative investments into real estate or REITs. And so to me, I feel like you're playing it so safe at your age and your wife's age that you're leaving way too much money on the table. I would trim down a lot of that cash, have your emergency fund, build up your bridge account, have more diversification because you guys are crushing it. But over the next 20 to 30 years, you could really become multi-millionaires if you put these funds to work in the right manner and have them diversified across multiple sectors of investing.
I totally agree. So just kind of breaking this out tactically, right? Have an emergency fund. For you guys, that might be $30,000. I feel like that's pretty good. Set $30,000 aside into a high yield savings account. Call that your emergency fund. Next, you want to buy a house and you want to put $120,000 to $160,000 down for it. Cool. You have all of this money. You should now just take $150,000, set it in a high yield savings account, and then go on a mission to go buy a house because that's what you want to do. Once you've done that, rent out your current house, whatever, like you guys go figure that out. But now that leaves us with $103,000 in a CD. That all needs to be invested into the S&P 500, VTI, VOO, VGT, QQQ, MOAT, things like that. You need this money working for you. You shouldn't just have it sit here making 4, 5, 6%. It needs to make a long-standing 8, 9, 10, 12, 13%, right? I know it only sounds like 5% or 7%, but when you extrapolate that over your 30-year investment horizon, we're talking about millions of dollars here, man. So make sure your CD is invested correctly. You have 104 in a traditional IRA. Make sure that that's invested correctly. We're talking about index funds here. We're not talking about international. We're not talking about bonds. We're not talking about anything. No target date funds. Give me the index funds, baby. And then 33K in a Roth, same deal. The 88,000 you have in a money market fund, that's just another word for a high yield savings account. You can pull from some of that and use that as your down payment for this house. Set that aside. 23,000 in your checking account. Maybe you just haven't taken the money out yet. I think for me, a good amount to keep my checking account is about 1 month's worth of spending. So if you spend, I mean, you're making 350K, you guys are probably spending like 8 to 10,000 a month, I'd say. Roughly speaking here, I think that'd be a good range considering your income and what your existing mortgage might be. So keep maybe 8, 10, 12,000 in your checking account, but you don't need $23,000 sitting in a checking account. This doesn't make sense to me. But you also don't need just 2,000 either, right? You guys have big payments, big things that come out. Like you guys make a lot of money. It makes sense. So just to summarize there, do what Robert said, get your money working for you. You're so young. You guys have 30, 40, 50 years of investing ahead of you. Do not be on the sidelines. I understand that you guys are saving up all this money to go buy a house. You've done a great job saving it. You guys are obviously very high earners. Like Robert said, you got the hard part out of the way. You know how to make the money. You got a big shovel. Now it's time to put that money to work and become a multi-millionaire before the age of 65.
I love it. And I'm going to say 2 more quick things that I talk about a lot. Parked money is dead money. So get out there, get it active. And number 2, always make your money work as hard for you as you work to get it. And you need to get that out there, get some of that money working for you because you're just leaving too much on the table by having it parked in all of these lower earning vehicles that you have.
Really good question, Andrew, as well as a question from Jordan and our statement question from David. We appreciate everyone's questions. And don't forget to subscribe to the Rich Habits newsletter. It's our free weekly newsletter, comes out every Thursday morning. We got about 45,000 people subscribed over there. We're adding about 80 to 100 new subscribers every single day. Get a lot of positive feedback on that newsletter. And if you've not yet subscribed, it's going to be in the link in the show notes below. And of course, check out the show notes below for all of our episode sponsors as well.
And always remember, it helps us when you join our public lives, when you follow us on Instagram, when you give us rave reviews, if you find value in the podcast, when you share it with a friend. All of those things you can do for free and in seconds. And so just keep in mind that as we build bigger and bigger, you can help us as well. So if you find value from all the work we put in through the podcast and the Rich Habits Network, just make sure to share it with a friend. Give us those 5-star reviews and let people know what you're watching.
Thanks, everyone, and have a great start to your week.